Time now for our Hot Pick segment. Our next guest recommends 3 consumer retailers, big players in the U.S., as defensive plays in this current uncertain economic and market environment. Joining us from Edmonton is Lilly Tzvetkova, co-head of U.S. equities and senior portfolio manager at CWB Wealth Management. Lilly, thanks a lot for joining us. Just before we get to your individual stocks, tell us what you look for in a defensive retailing stock.
Hi, good morning, Paul. Happy to be here. So in today's environment, obviously, defense is a good thing to have. And what we're looking for is a business model that's resilient and that could do well in any environment. And what I'm saying, what I'm meaning by that is that customers will continue going on. And as I'm going to give you some examples later on, you'll see why. But there could be different reasons. For me, value is one of the big reasons. And then just the general appeal of what you're selling and how you're doing it. Customer service is also super important here.
Okay. Number one, your first pick in this sector, TJX, ticker symbol TGX. You've got a buy rating on this one and a price target of $125 per share.
Correct. So TJX, for those of you who don't know, they're the largest off-price retailer globally. They are known here by their Winners brand or Marshalls, and their value proposition really lies in the fact that they offer tremendous value to their consumers. You can sometimes get a $500 Ralph Lauren coat for just $150, and in today's environment, that's really important. So why here and why now? Well, first of all, when you think about the tariffs, like they're going to be a lot less exposed than a lot of other retailers. And the reason is that they don't source directly from factories overseas. How they source their merchandise is typically once they're already in place, let's say in the US, by the branded manufacturers because of some dislocation of inventories. Going back to inventories, in today's environment, we think inventory is going to be a lot more there's going to be a lot more inventories than usual. And the reason is that a lot of the retailers actually rush to buy inventories before the tariff announcements. And we think there's going to be some dislocation and TJX will benefit from that. And third thing is really this trading down. Obviously, in these uncertain times, we have inflation, we have the economy going who knows where. Because customers are very value cautious, and this is what TJX offers. Now, historically, if you look at history, they've really done well. During all times, they're able to grab market share. They're able to grow same-store sales basically through almost every period except for COVID. And they also have some growth opportunities ahead of them. There's still some white space, both domestically, but also abroad. Yes, valuation might not look very cheap, but I think for a 10% EPS grower and with a resilient business model that they offer, it's more than justified.
Okay. Number 2 is AutoZone, a big maker and seller of auto parts and accessories. Not a maker, it's a seller of auto replacement parts and sellers. Why do you like AutoZone?
So AutoZone, first of all, they are the largest player in the U.S. They work in a space with a bunch of other companies that are doing pretty well, and they typically cater to the people like you and me or people who like to repair their own cars, although they also have some business in the pro segment as well. So why we like them? Definitely more resilient versus other retailers, and mostly because when your car breaks, you really have to fix it, and typically you have to fix it now. You can't really delay that purchase in this particular case, the auto parts. And in the past, they've been able to also really pass cost to the end consumer without having a significant impact in their revenue. Yes, tariffs are going to have some impact on them because they source a lot of their products from overseas. But what people sometimes underestimate is that tariffs are placed on all products, including new cars. And what this could mean is that now people are holding on to their old car for longer. And when the longer they hold to their car, the more they need to repair. So obviously a tailwind to AutoZone. This trend's actually been going on for some time now, so it's not really new. Now, if you look at the average age of the cars in the US, it's actually about 2 years higher than what it was 10 or 12 years ago. And so that's a tailwind for AutoZone and the other players in the industry. It is a great business model and it has been a great capital return story. Over the last 20 years, they basically purchased about 80% of their shares, benefiting the existing shareholders a lot.
Okay, and the third pick on this day, a very familiar name to stock market investors, Costco, a highly regarded company. The debate on Costco tends to be on its valuation. It's now trading at about 52 times expected earnings. Why do you like Costco?
I know valuation is a big point there, but when you look at valuation, and you have to look at the business model, this is the most resilient and one of the best business models that are out there, not only in retail, but just in general. Now, when you look in times like that, and a lot of people were thinking, no, it's so expensive, it's not going to do so well, but it keeps on doing well, and there is a reason behind that. First of all, they do well in all economic times. And if you look at all of the years behind us, you see that. So first of all, trading down. A lot of, like we talked about trading down with TJX, customers tend to trade down during bad economic times, and Costco's been really a place to be. Even when after COVID, there was a time where discretionary were not doing very well elsewhere, Costco did actually outstanding, because you're saying, you know what, if I'm going to be buying this discretionary product, I better buy it at the best price. And this is what people do. Now, when it comes to tariffs, like people are worried about tariffs, and about a third of Costco's products that are being sold in the U.S. are subject to tariffs. But because of the huge scale that Costco have, they're able to negotiate with suppliers, and I have no doubt they'll be able to negotiate some deals and pass them to the end consumer. And because they have those revenues coming from the subscription revenues coming from those things, they're able to actually stay profitable even with those lower costs. Long term, I think there is underappreciated in the market the ability to open new stores, both domestically and internationally. So that's why we still like it here.